Hi guys, Chris Weston here, Head of Research at Pepperstone. We're going to go through once again all things in the gold market. I will let you know that I do have a bit of a dodgy camera. My webcam may freeze at any stage, so apologies for that. It's one of the joys of working from home, I guess, and having some iffy technology. So yeah, if it does go, I apologise for that, and hopefully we can continue on, soldier on. But it's the content, of course, which is always the best thing. If you do find yourself liking the video, obviously hit the like button. I really appreciate if you could do that. If you want to subscribe, then that's fantastic as well. What we're going to do is we're going to go straight into the technical charts to look at the setup, because I think if we have a look at what's going on in the dollar market, in dollar gold, XAUUSD, you can see that we're just trading sideways. The market really doesn't know what to do at the moment with the gold price, and we're going to go through some of the fundamental inputs that we see. And let's go into the chart so you can actually see it for yourself here. So we've got the daily chart of XAU USD, and we've got Jackson Hole tomorrow. Jerome Powell will be speaking. I don't think anyone's expecting anything significant to come out then. Again, it's just laying the groundworks for tapering, which I believe will come in the November meeting. I think you're going to see the September Fed meeting coming on the 23rd. They'll obviously have another payrolls number there. We get the September payrolls number coming out in early October, and that will give us a chance then to have a look at whether some of these benefits will wear off, and see what the labour market looks like there, whether more people come back into the labour force as a result of that. And then we should be in a position then for the Fed to announce tapering and a timeline around that. Of course, it's more important about the pace of tapering for the dollar and for gold and some of the second derivatives of that. But as we're moving through this cycle, have a look at what we're seeing in gold price. Now, you can see that the 5-day moving average is moving perfectly sideways at the moment. The gold price is mean reverting. Price is above that level. It sort of comes back down. That's moving sideways at the moment. So there's really no clear trend. The trend at the moment is perfectly sideways. Have a look at the RSI. You can see that the RSI is mid-range. So let's slap a Bollinger Band on this and give us some context, because what we like to see is markets don't always trend. We don't always have to buy strength. We don't always have to buy weakness. When markets are moving sideways, because we don't really know why gold's doing what it is it an inflation hedge? Are we seeing real rates moving around? We don't always have to buy and continue to add to long positions in a trend or look to short gold. Sometimes we can just trade a range, and I think what we're seeing right now is an absolute textbook range trader's paradise. So what I've done is I've drawn a simple Bollinger Band on there, and you can see the upper and lower Bollinger Band, the 20-day moving average. This is this sort of thin line, blue line here. And we've obviously got two standard deviations. We know that standard deviations capture 95% of outcomes. So that's when we see the RSI mid-range and the Bollinger Band. This is perfect situation. So what we're doing is we're really looking for a confluence of resistance levels. And we can see that this double top that came in around 1834, that sort of coincides with the Bollinger, but with the upper Bollinger Band. Obviously, we need to break through these highs in the short term. But I think for me, in the short term, the very immediate short term, whether it's this week or whether it's the beginning of next week, looking to fade moves into this top end of the Bollinger Band seem to be probably the more predictable trade at the moment. If we get a move through these lows, on the other hand, because it could go either way, we're in that kind of situation where price really needs to reveal itself. These series of lows that we got around 1775, if it breaks through that, then I'd expect it to trade into 1765. That would be my first target. So at the moment, we've got this kind of sideways trading market. And if it goes higher, then we're going to look to fade, or I'm going to look to fade into that rally. And if it goes lower, I'm going to look to buy into that situation there and continue to respect this trend that we've been seeing. The really, really strong conviction, in my opinion, comes down into 1740. If I can look to buy gold into 1740, that to me is the high conviction play. And what I'm doing is I'm not just using Bollinger Bands, which give us a sense of realized volatility, where these standard deviations relative to the 20-day moving average. But what I've actually done is I've looked at the straddle pricing as well. I've had a look at forward implied volatility and the break-even rates. And what we're looking at is the distribution. This is quite complex for some people who are not familiar with the options market. But what we can do is we can see this number 2. This is what we call a 10 delta strangle. And it really gives us a sense that the market is saying with a 90% probability that the gold market is not going to move through this level of 1841, and with a 90% probability of 1739. That's on weekly options. So what I'm using is realized volatility using the Bollinger Band, and I'm also using our options strategies to look forward at what the market is saying. The price with a 90% level of confidence is not going to break through these levels. So given that the price is moving sideways, we've got the RSI mid-range, I personally think there is a very high conviction situation in the next couple of days, certainly through Friday and into Monday, that anything into 1841 would give me a really good opportunity to fade that for a mean reverting move, and anything really between these levels down into 1740 I think would be in the next few days would give me a really strong conviction of looking to buy that for a mean reverting move. So we're not always having to trade trends. Sometimes we can trade mean reversion, sometimes we can trade a range, and right now I think with everything that's going on, this is a mean reverting market, and I really want to trade with a high level of conviction 1842 down into 1741. Any kind of move into that I think is a really strong opportunity to trade that. So that's really what we're looking at on the week. In terms of gold in other currencies as well, we've seen the euro starting to make a nice move up. Have a look at euro yen. Really interesting scenario playing through in euro yen. We've seen a break of this downtrend that's played through. I'm just going to remove the Bollinger Band. We've seen this break through this series of lows, and of course, when gold's moving around, what we tend to do is look at the currency effect. And I really think what's happened in the gold market over the last 5 days or so has really been a dollar play more than anything else. I think what you're seeing is when you're seeing that euro strength, that's really weighing on the gold price. So when we can look at gold, we can look at it in other currencies. And at Pepperstone, we do offer gold in other currencies as well. So if we're looking to go short, we tend to want to go short in the strongest currency. If we want to go long of gold, we want to do it in the weakest currency. And the weakest currency over the last 5 days has been the US dollar. So that's why we've seen gold in US dollars working okay, I guess. But you've seen some good strength coming through in euro dollar. And also euro yen and some of the other currencies there as well, and that's weighed on the gold price. So let's have a look at gold in euro terms, because I think this is an interesting trade as well. We've got this price holding up above these series of lows, 15, 15, 18. I think if that gives way, then you've got to test this 200-day moving average. It's not necessarily about getting set right now. We want to wait for the sellers to kick us into a trade, wait for the flow to really dictate and a higher probability outcome. And that, for me, if I'm looking at daily charts here, comes on a break of these lows, which you can see there's strong bids coming in pretty much every time. And when that gives way, I think that will give us a sense that the sellers are in control of this market. And I think we probably go along for the ride in that situation as well. Have we got reflation coming through? Well, we started to see a re-emergence of the Australian dollar. We've seen a stronger Australian dollar. Have a look at what that's doing to the gold price in Australian dollar terms. This series of lower highs and lower lows coming through, and that looks like it might be starting a trend. It's trading just below the 5-day exponential moving average. If this starts rolling over, I would probably go short on that situation. We've been pretty bullish on gold in Aussie dollar terms because we were thinking that the Aussie was going to be one of the weaker currencies, and that trade's worked out fairly well. But we're starting to see a little bit of strength playing through in the Aussie dollar, bit of short covering coming through, and that's weighing on gold in Aussie dollar terms there. So a little bit of a move down into these levels wouldn't be a surprise into 24.28. But of course, Pepperstone, like anywhere else, we're seeing all our flow, most of our flow in gold in US dollar terms. And right now, with it sort of just trading sideways, it could go either way. I can't really predict. Longer term, my own thesis on gold is, and I'm sure there's a lot of people who are watching this will vehemently disagree with my call, is I think we've become quite rich and hit a fair value in terms of break-even rates or inflation expectations. We've started to see a little bit of sell-off coming through in US Treasury markets. Let's have a look at that now. You can have a look at 10-year Treasuries, and you've seen a little bit of selling coming through, which is pushing yields higher. If we get a break of this level 137, then I think you're probably likely to go up into 145, perhaps even to 150. Obviously, that's going to be a reflection of what's happening in Fed expectations and various factors. And I think that probably will start weighing on the gold price. Now let's have a look at the fundamentals, because what's really interesting is actually, let's take it into the volatility structures. We talk about this gold market going sideways, and then I look across and go really deeper into the markets to explore what exactly has been going on. And if I have a look at 1 week implied volatility in the gold market, so this is the options market, and you can see that 1 week implied volatility is just doing nothing at the moment. It's moving perfectly sideways. So options market makers are just not sensing any kind of move either way. They're not prepared to reprice gold and the potential for a movement going forward over a week period on a rolling basis. So implied volatility in gold is telling me right now that market makers are just seeing this kind of hodgepodge of melting news that's coming through, and they're not prepared to act. They're not prepared to change volatility structures. And it really sort of feeds into that price action that we've been seeing, which is perfectly sideways. If we have a look at risk reversals, which look at the skew of call volatility relative to put volatility and where people see the propensity of movement, again, we come back to zero. So it's pretty neutral. Again, this is deep option stuff, and some people might not be familiar with this, but in layman's terms, what this is telling me is that when people are looking at the propensity for a higher move up or explosive move down, it's very neutral at the moment. People are just seeing very mixed situations, and it really plays into the idea of that mean reversion range trade. Now let's have a look at this fundamental catalyst. A lot of people talk about the idea that real rates or inflation-adjusted Treasury yields are the driver of gold, and that for a long period of time has been very much true. As we know that gold has no yield, so when we see a situation like this white line at the top here, where real rates or inflation-adjusted Treasury yields are becoming deeper negative, we got down to negative 120 basis points in early August. What happens with gold is that it becomes that yieldless asset becomes yield perversely in itself, and this is where you get that store of value that everyone talks about. I'm getting a deeper negative real return in the Treasury market when I can get zero effectively in gold. That's where its store of value comes in. Now, for a large period of time, what we saw, as you can see here in this top pane, is that when real rates were moving down into deeper negative territory, there was a bid coming through in gold. And you can see for a long time that this was very much trading inversely. Now that relationship has firmly broken down. And as you can see here, that real Treasury rates have been moving up. They're becoming less negative, which for large portions of history was a really negative situation for the gold price. You would usually see when real rates are moving up here, it becoming a headwind for gold. It becomes a positive factor for the US dollar, and those cross currents of less negative real yields and a stronger US dollar therefore weighs on the gold price. Look at what's happened really since about the 9th of August. We've seen a situation where real rates have gone up and gold price has been going up as well. The US dollar's been going up. So it's a really kind of weird time. This idea that it's strong relationship. What a lot of fund managers know why they buy gold. They go buy gold because it's a hedge against lower real rates. Well, that's broken down, and again, it kind of feeds into this idea. We don't really know what's driving gold at the moment. Is it an inflation hedge? Well, real rates have been rising, and gold's been fairly stable. Is it a hedge against currency debasement? Well, less of that's coming out of the market. So we don't really know why gold is doing what it's doing. Some people talk about manipulation from bullion banks. I'm not so sure. But right now, when you don't really know the fundamental thesis behind why gold's moving in one way or the other, again, it just comes back into my idea that in a situation where you don't really know what's going on, that you get a situation where, let's go back to the gold price here. It does this. It moves sideways. And you can see that we're pretty much back, despite all the drama and all the talk about tapering and all the other factors that we've been seeing, that we're pretty much back to where we were on the 6th of August before this crazy liquidation move that we saw on that Monday. So we're really back to those points at the moment. So when the correlations break down in markets, we know what really drives gold. We come back to our friend Flow. Let's have a look at Flow. Have a look at the GLD, the gold ETF. We just released this for clients to be able to trade as an ETF. If you want to go and trade the gold as an ETF, you can do so. Obviously, most of our clients are going to trade gold as a CFD because it's open 24 hours a day and the costs are very, very cheap indeed. But you can see here, if we have a look at the estimated money flow, which is one of the great things about ETFs, is being able to get flow data is a lot more transparent than other markets. And you can see here that the levels of outflows that you're seeing from the gold ETF, which of course we can extrapolate into other markets like the underlying gold price, has been falling. So we've seen continuous and this cumulative money flow has been money flowing out of gold in that situation. So again, that feeds into the idea that in the GLD, that's a really good idea that money has been coming out of there. If we have a look at the intraday ranges. And this is really important for day traders and people who are trading short term. What I've done here is I've looked at the high minus the low, and I've used that range and I've divided that by the previous day's close. So we can see the percentage daily ranges. And what we've got here is the red line is a 5-day moving average. And we can see that the ranges have been falling. Okay, so you can see on average over the last 5 days, we've now got the lowest percentage high-low range. Well, I can go back. I mean, we can go back for a long period of time, but basically we've got the lowest range now. And if we combine that with that volatility structure that we saw, where the implied volatility is going perfectly sideways, the fact that we've disincentivized from what's happening in real rates, there's no correlation whatsoever. It's very difficult to trade the gold price. People are saying, "What's it used for? Why? What's going on?" And in that situation, it just plays into one thing: uncertainty breeds sideways trade action. And so, whilst I like to trade trends, um, we can also we have to adapt to the financial situation that we see in front of us. And right now, that situation is that we're looking to mean revert this trade. So I think anything into 1834. I think in the short term is an opportunity to look to fade that move for a back move back into the 1800s. I think anything down into 1740 in the short term would be grossly oversold, and I think that would give me the opportunity to mean revert that situation there as well. So I'm looking to mean revert this market. I'm looking to range trade the gold price in the moment. When all of these correlations are breaking down, if we look at the fund flow and everything that's going on, all the signs there at the moment is that the gold price is going to be one that we can range trade. Longer term, though, it comes back to my friend that I think break-even rates or inflation expectations are fair valued. I think we're going to see nominal Treasury yields moving higher, and therefore I think we will see real rates moving higher. And I think once that rate of change starts moving up, that's going to push the US dollar higher, and I think that will weigh on the gold price as well longer term. In the short term, though, as I say, the market's trying to understand a few things. Those correlations are broken down, and I like to range trade that. So have a look for yourself. Reach out to the comments. Have a look at. Let me know what you think about the gold price in the short term, as well as the long term, both in US dollars and also some of the other currencies as well. If you want for more information about trading gold, do reach out to myself or the team at Pepperstone. Happy to talk about those in the short term and what's going on there. As I say, if you find yourself liking the video, do click on the like button. It'd be really, really great for the channel and hopefully for more of these going forward. But good luck at trading gold this week. Obviously hoping for some positive returns for everyone involved, and stay safe and trade it with Pepperstone. Thanks, guys.